Welcome to the captivating world of REIT investing, where financial growth and solid returns are the name of the game. In the next 10 minutes, we'll embark on a journey demystifying the intriguing realm of real estate investment trusts, commonly known as REITs. Imagine being able to invest in high-quality real estate assets without the hassle of buying or managing properties. That's the beauty of REITs. They offer a unique way to invest in real estate, providing regular income streams, diversification, and long-term capital appreciation. Whether you're a seasoned investor seeking to diversify your portfolio, or a novice dipping your toes into the investment world, understanding REITs can open up exciting new avenues for your financial growth. In this video, we'll break down the concept of REITs, explore the different types, guide you on how to invest, and discuss the associated risks. Are you ready to dive into the world of REITs? Buckle up, because the journey starts now. Enjoying this content? Don't miss out on future videos filled with even more tips, tricks, and inspiration. Hit that subscribe button now to stay tuned with us. First things first, we need to understand what a REIT is. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-generating real estate. Think of it as a mutual fund for real estate. Instead of investing in stocks or bonds, you're investing in property. It's a way for you, as an investor, to earn a share of the income produced through commercial real estate ownership, without actually having to go out and buy commercial real estate. So, how does it work? Well, REITs pool the capital of numerous investors. This makes it possible for individual investors to earn dividends from real estate investments, without the need to buy, manage, or finance any properties themselves. Because of this, REITs are an excellent way for investors to add real estate exposure to their portfolio, without all the hassles of being a landlord. Now let's talk about the benefits of investing in REITs. One of the primary advantages is the potential for high total returns. Thanks to their unique blend of income and growth, REITs have historically provided competitive total returns, based on high, steady dividend income and long-term capital appreciation. Another advantage is liquidity. Unlike direct real estate investments, REIT shares can be quickly and easily sold. They're traded on major stock exchanges just like any other stock. And let's not forget about diversification. REITs invest in a wide range of real estate property types, including offices, apartment buildings, warehouses, retail centers, medical facilities, and hotels. This gives investors the opportunity to diversify their portfolio beyond traditional securities. Lastly, there's the benefit of transparency. REITs are required to disclose exhaustive financials and are subject to the same rigorous reporting standards as public companies, so in a nutshell, REITs offer a way for anyone to invest in portfolios of real estate assets. Pretty neat, huh? Now, not all REITs are created equal. There are different types to choose from. So, let's dive into the world of REITs and explore the various kinds we have out there. First off, we have equity REITs. These are the most common type of REITs, and they make their money by owning and operating income-producing real estate. This could be anything from shopping centers, apartments, offices, hotels, to warehouses. The income generated from these properties through rent and lease payments is then distributed to shareholders as dividends. So if you're looking for a steady income stream, equity REITs might be your go-to. Then we have mortgage REITs, also known as MREITs. These REITs don't own real estate directly. Instead, they deal with the financing side of real estate. They make their money by lending money to real estate owners, or buying existing mortgages or mortgage-backed securities. They profit from the interest on these loans and securities. Now, while the yields can be high, MREITs can be a little more volatile, especially in fluctuating interest rate environments. Lastly, we have hybrid REITs. As the name suggests, these are a mix of the first two types. They own properties and have a hand in real estate financing. This means they earn money both from property rents and interest on loans. Hybrid REITs can offer a balanced blend of investment, but they also carry the combined risks of equity and mortgage REITs. With these different types of REITs, it's important to understand that each comes with its own unique risks and rewards. Some might offer higher dividends but carry more risk, while others could offer stability but lower yields. It's all about finding the right fit for your investment goals and risk tolerance. Choosing the right type of REIT for your investment strategy is a crucial first step. So, take your time, do your research, and make sure you're making an informed decision. After all, investing is not just about making money, it's about making smart money moves. So, you've got your sights set on the REIT that suits your investment goals. Now how do you invest? Let's break it down into simple steps. First and foremost, it's all about research. Just like any other investment, you'll want to do your due diligence before putting your hard-earned money into a REIT. Look into the company's financials, find out about their management team, and check out their property portfolio. Remember, a REIT is only as good as the properties it owns and the team that manages them. Next, consider the type of REIT that aligns with your investment strategy. Are you interested in commercial properties, residential properties, or perhaps a mix of both? Different types of REITs bring varied levels of risk and reward, so choose wisely. Once you've done your research and decided on the type of REIT, it's time to invest. But how? Well, buying shares in a REIT is similar to buying shares in any other publicly traded company. You can purchase them through a brokerage account. If you don't have one, there are plenty of online platforms where you can set one up. When it comes to the actual purchase, you have two main options. You can either buy shares at the current market price, or you can set a limit order, which allows you to specify the maximum price you're willing to pay per share. This could help you get a better deal, especially in a volatile market. Post-purchase, keep a keen eye on your investment. Regularly review the REIT's performance and stay updated with any news or changes in the property market. This will help you make informed decisions about when to hold, sell, or buy more shares. Investing in REITs can be a fantastic way to dip your toes into the real estate market without the need for a huge capital outlay or the headaches of property management. And remember, like all investments, it's not about quick wins but about long-term growth and stability. With these steps, you are well on your way to becoming a successful REIT investor. Before you dive headfirst into REIT investing, it's important to understand the risks involved. Now, while REITs offer the potential for high returns and diversification, they also come with their share of risks, as does any investment. Firstly, there's the market risk. REITs are subject to the same fluctuations and market conditions as any other stock. A downturn in the real estate market can significantly impact the value of your REIT investment. For instance, a recession or a sudden drop in property values can lead to lower rental income and property valuations, which could negatively affect your returns. Secondly, we have interest rate risk. REITs are particularly sensitive to interest rate changes. When interest rates rise, the cost of borrowing increases for REITs, which can lower their profits. Additionally, higher interest rates can make other investments more attractive, causing investors to sell their REIT shares, leading to a decrease in their value. Thirdly, there's the liquidity risk. Some types of REITs, particularly non-traded ones, can be quite illiquid. This means you may not be able to sell your shares quickly or at a favorable price when you need to. Then, we have the management risk. The performance of a REIT largely depends on the skill of its management team. Poor decision-making or ineffective strategies can lead to losses. Lastly, there's the risk of overconcentration. If a REIT focuses too heavily on one type of property or geographic area, it may be more vulnerable to downturns in that specific market. In conclusion, while REITs can be a valuable part of your investment portfolio, it's essential to balance the potential benefits with these inherent risks. Consider your financial goals, risk tolerance, and investment timeline before deciding to invest. Remember, diversification is key to managing risk. You might want to consider spreading your investments across different types of REITs and other asset classes to mitigate potential losses. Being aware of these risks will help you make informed decisions and manage your investments wisely. As we wrap up, remember, REIT investing is a journey, not a sprint. We've traversed the landscape of real estate investment trusts, delving into what they are, the different types available, and how to invest in them. We've also touched on the inherent risks and the importance of a well-informed decision. These are but stepping stones on the path to financial growth and security. The key to successful investing lies in continuous learning and diligent research. Uncovering the nuances of REIT investing will not happen overnight, but with patience and perseverance, the rewards can be substantial. Investing is a venture of discovery, where knowledge is your compass and curiosity your guide. So, keep asking questions, keep exploring, and keep expanding your financial horizons. Thanks for joining us in this exploration of REIT investing. If you found this video helpful, please give it a thumbs up, subscribe to our channel and share it with your friends. Stay tuned for more insightful investing videos. Happy investing!